Well, I bet you may have heard of something about the bond market, whether it is about the market crash, the bond yield or its price blah blah blah. But what is a bond actually and how can you benefit from it? Let's continue and find out. So what is a bond? A bond is a loan to the borrower, that is usually a corporation or government. When you buy a bond, you are actually lending money to the issuer. The bond you buy would include details about the amount of interest they pay you every year, and the maturity date. This is the time when the borrower have to return the money they borrowed. There are several specific terms you'll have to know before venturing into the bond market. The first one is face value. It is the amount of money the bond will worth at maturity. Another term is called coupon rate. It is the interest rate the bond issuer would pay you, based on the face value of the bond. Consider a bond with $1,000 face value and 3% coupon rate. After you buy the bond, you would get $30 per year as interest, and on the day of maturity, you will get your $1,000 back. Simple, right? Apart from the interests given, there is another way for you to profit from the bond market, which is selling the bond before maturity. Consider your $1,000 bond with 3% coupon rate. If you want to sell your bond next year to get the cash, while the interest rate drops to 2%, that means people buying the bond next year would only get $20 per year. At this moment, your bond would become attractive, as it offers higher interest rates than other newly issued bonds. You would be able to sell your bond at a higher price than the one you bought. In other words, you will gain from selling your bond when the interest rate becomes lower. However, it also shows the risk of rising interest rate on bond market. Consider another example. If next year interest rate is raised to 5%, that means people buying the bond next year would get $50 per year instead. Then who else is going to buy your bond? Hence, in order to make your bond reasonably attractive, you will have to lower your price when you sell it, which would erode your profit. A longer-term bond is more susceptible to risk of interest rate hikes, as there will be greater uncertainty for interest rate in a longer period. This is the reason why long-term bonds has higher interest rates than the short-term ones. Greater rewards come with greater risks. However, you should keep in mind that investing in bond is to reduce risks of your portfolio, not to bear extra risks. You can choose to bear risks and chase after better rewards in the stock market instead. Hence, you should buy short-term or intermediate-term bonds, to minimize risks in your portfolio. Another risk of bond is the default risk, which means the bond issuer goes bankrupt and is unable to pay back the capital you invested. There is a bond ratings offered by different companies, to judge the credit quality of different bond issuer. In other words, the rating reveals how likely the issuer would return the money. To make the deal attractive, the lower-rated corporation bond offer higher interest rates. Again, greater rewards come with greater risks. But remember, you don't want to bear much risks in the bond market, so investing in Treasury bond, which is the bond issued by U.S. government, is the safest deal. In the second episode, we will explain how you can invest in bond markets, and show you the best way to make money with bonds. Make sure you have subscribed and turned on the notifications.